I don't want to hear from you saying, yeah, but what about this token and that token and my token's better than your token? This is not a fucking player versus player world. It is a player versus everything. We all want everybody to succeed here. Follow the don't fuck this up thesis. Don't have all of your stuff in small altcoins. Have about 80 or 90% in the main tokens and you'll be fine. But again, this is not a player versus player. We're not trying to outcompete with each other. We're all trying to win here. And that's very important to me. Okay, so financial conditions are kind of the big daddy of all of this. And the 3-month and 3-month rate of change of Bitcoin is driven by financial conditions, which leads by 3 months. So financial conditions obviously tightened because of the dollar and rates back in last year. Now Bitcoin has fully priced that in. So we're at the price point.
Raoul Pal makes an important observation at the beginning of his talk. Liquidity is everything. He highlights that the secret to successfully navigating markets in today's financial environment is an awareness of liquidity flows. Those that understand liquidity trends have a significant edge, regardless of the changes in the money supply, central bank policies, or institutional inflows. He cautions against getting caught up in market noise and short-term narratives. He advises investors to concentrate on the wider picture and macro trends instead. It might be challenging to time the market, but aligning yourself with long-term liquidity cycles can change everything. Raoul emphasizes the value of flexibility when markets hit a crucial stage. The key to long-term success is being informed, avoiding emotional decisions, and identifying big developments. Please remember to like this video, subscribe to our channel, and enable post notifications if you have a strong interest in learning about the future of finance and the function of digital assets like Bitcoin. This will ensure that you never miss anything. Thank you, and enjoy the video.
Anyway, let's go through how not to fuck this up. I've got the Don't Fuck This Up t-shirt on. You can now understand again what I keep saying. If you're using leverage, you are going to get blown out and you're going to lose control of your tokens. That is rule number 1. Do not lose control of your tokens. Do not use leverage. Don't FOMO and don't get fearful at the wrong points in the cycle. We have a framework. It's there to help you. We are still early stage within the final year of the crypto bull market when a lot of the big gains come. It's time not to lose your shit. Have patience. See the bigger picture. Also, how you construct your portfolio. I'm saying, well, 35% pullbacks are par for the course. And you're saying to me, oh my God, my fucking portfolio is down 80%. It's because you're not using the don't fuck this up thesis, which is you can only have a small part of your portfolio in the smaller tokens. Yes, I also understand that Solana is down 55% or 53% today. And it's painful for many of you because Solana's a big position. But again, over time, you'll see that this kind of volatility is normal in a token at this stage, and you should be fine with all of that. So if you can, you buy the dip. And let me show you why and how. So I'm going to run through some charts for you that Julian and I put together specifically for you. These are from Global Macro Investor, which is my preeminent research service. Firstly, the chart that everybody knows about. This is the chart Julian and I came up with, Global M2 in dollars with a 10-week lead over Bitcoin. Now, we were not sure whether it was going to follow this exactly because we had an identical setup in Global M2 in 2017 in the last Trump cycle. And what happened is crypto collapsed 35% in a week and then slowly recovered with CHOP. I wasn't sure whether we were going to have the full sell-off to follow this pattern or we were going to go sideways over the period. We eventually went sideways first and then had the sell-off. Either way, it's on track exactly as Global M2. What it's saying to you is that financial conditions that tightened last year due to the dollar rallying in anticipation of Trump and also rates going up in anticipation of tariffs, well, that is what's playing through now. Now, if you look at the chart going forwards, that reverses. Yes, there's going to be a period of chop. We're going to be finding the lows around here, and I'll come more on that in a sec. Then there's a period of chop, and then we start coming back up the other side. So it's nothing to concern yourselves with. Volatility is part of the game. Without the volatility on the downside, you don't get the 150% returns or more on the upside. So anyway, calm down, have patience, let this play out. Solana, I know many of you are in Solana, and Solana got nuked because of the collapse of the meme coin economy. Now, I think Solana, as you know, is a very broad, deep protocol. There is a lot of activity that goes on. There will be other activity that replaces memes. Some memes will come back to life. It is not what people are saying. It's a scam coin. It's a dead coin. It's all fucking nonsense. But Solana has overshot versus Global M2. And that is this last leg of the cycle. So Solana is looking very cheap, and I'll show you a bit more on that in a sec. So that's interesting. Again, you should be thinking about the dips. Solana should outperform Bitcoin for the rest of this cycle, and Ethereum too, with Sui outperforming Solana. Those are my bets. Now, I don't want to hear from you saying, yeah, but what about this token and that token, and my token's better than your token? This is not a fucking player versus player world. It is a player versus everything. We all want everybody to succeed here. Follow the don't fuck this up thesis. Don't have all of your stuff in small altcoins. Have about 80 or 90% in the main tokens, and you'll be fine. But again, this is not a player versus player. We're not trying to outcompete with each other. We're all trying to win here, and that's very important to me. Okay, so financial conditions are kind of the big daddy of all of this, and the 3-month and 3-month rate of change of Bitcoin is driven by financial conditions, which leads by 3 months. So financial conditions obviously tightened because of the dollar and rates back in last year. Now Bitcoin has fully priced that in. So we're at the price point that is right. Now, could it then chop around along the bottom until it starts mirroring the rally in financial conditions? Possibly. This is also obviously very similar to the global M2 chart because they're all highly correlated. I just want to show it to you in a different way. The next chart is what you're hearing a lot of noise about is there's an economic weakness coming. Economic data's coming out weak. Yes, it is. And it's been driven by the dollar last year. Again, there is a lead here, and the dollar strength last year is causing economic weakness. This is the reason everybody wants a weaker dollar.
Raoul Pal emphasizes that liquidity is influenced by more than simply U.S. policies. Global financial markets are intricately intertwined. Large nations like Europe, Japan, and China also have a significant influence. One important element is the financial sector in Japan, which is vital to the worldwide euro-dollar exchange rate. Japanese banks may add more liquidity to the system when the value of the U.S. dollar declines, which helps markets all around the world, including those in China. Additionally, global M2 money supply trends suggest that liquidity will continue to grow this year. Risky assets like tech stocks and cryptocurrency are expected to continue rising if this pattern continues. Despite the anticipated short-term volatility, the overall outlook is still favorable. Please take a moment to like this video, subscribe to the channel, and enable post notifications for future Bitcoin, macroeconomic, and digital asset content before we go any further. Now, let's get into his powerful predictions.
China wants a weaker dollar so they can stimulate. They're desperate to stimulate. The world has a lot of dollar debts. They need a weaker dollar to service those debts. The US needs a weaker dollar to export goods. The global economy needs a weaker dollar. But first, we're going to see that weakening of the US economy because of what happened last year in the dollar. And then things will start to change again and the economic cycle will pick up. Now, that probably also means that rates will come lower because economic data is weaker. So that's playing into our idea that financial conditions are going to ease over time. So it's yet building a more positive case. No, it's not going to be a recession. All of that talk is nonsense. Economic data will weaken for a bit and then strengthen. But this is all good for us. Yes, tech stocks are slightly worried about weaker growth. But again, when we can look forwards, using the analysis, we can see recovery is round the corner. Now, when we look at last time around in 2017 when Trump came in, we saw a very similar thing. Economic surprises fell off a cliff because the dollar had strengthened in anticipation of Trump coming into office. That then eventually reversed and the economic cycle picked up massively and the dollar weakened hugely. And that drove what was a very large crypto and risk cycle, even though the Fed were raising rates. You see, global financial conditions are the key thing here, and that could be driven by the US, or it could be driven by China, or it could be driven by Europe. It could be any of these economic powers, or it could be all of them. So as the dollar weakens, we're already seeing that mechanisms like dollar yen are starting to move a lot more. Now, dollar yen is incredibly important because the Japanese banking system is the heart of the euro-dollar system. They're the ones who lend out dollars into the global economy, and that finds itself its backdoor into China that allows China to service its dollar debts. And if the dollar is weaker, then China can weaken its currency. It can then stimulate more aggressively. It needs to do trillions of dollars of QE to service the bankrupt real estate sector and other parts of the non-performing loan sector. So anyway, that's all to come. If we look at the dollar now versus then, very similar. Trump back then said the dollar is too strong. They've already talked about it, him and Scott Bessent. They've already talked about the long end of rates. What they want is the dollar to, first they will use the dollar as a bargaining tool with the Chinese, the Europeans, the Canadians, the Mexicans to get the tariffs in place. In exchange, they will give a weaker dollar. That helps everybody out. We can all then move forwards with the global economy, and the global economy should be strong. The back end of rates, which is like 10-year rates and stuff, well, that's going to help you guys too, because your mortgages will come down and borrowings for corporations will come down. And that gives everybody more money, and that stimulates economic growth. This is all to come. They've made it very clear that that's what they want to do. Global M2 back in 2017, exactly following this cycle. Same kind of administration with the same tariff policies. Dollar reacted the same, the markets reacted the same. So again, don't expect these to be perfection, but expect this to start playing out again. If this is the case, then M2 is going to keep going up all fucking year. If that is the case, then crypto and risk assets like tech will do well all year. Again, don't expect perfection. It won't be exact, but it'll be close enough. I don't see any reason why that won't be the case. And anybody telling you otherwise is just plucking stories. We do the analysis, lots and lots of it. We have hundreds upon hundreds, maybe thousands of charts on all of this.
According to Raoul Pal, the stability of the world economy depends on the US dollar declining. China needs a weaker dollar to encourage growth as it struggles with a slowing economy and a real estate crisis. When the dollar is strong, it is challenging for many nations, including China, to service their substantial dollar-denominated debt. A declining dollar also helps the United States because it increases the competitiveness of American exports. Pal believes that the cycle will change and that the economy will improve, even though the short-term view might contain lower economic data because of the strong currency from the previous year. Alongside this shift, interest rates will probably drop, improving financial conditions and boosting market confidence. He cites historical examples, such as the first time that Trump's presidency resulted in a dramatic increase in the value of the dollar, which created economic weakness. However, a significant bull cycle for IT and cryptocurrency stocks was fueled by improved global financial circumstances as the dollar declined later. Pal contends that financial markets are continuing a well-known cycle in the future. The M2 money supply, an indicator of global liquidity, is expected to grow throughout the year, which has historically been positive for riskier assets like tech stocks and cryptocurrencies. Even while market moves won't be flawless, the general trend rejects concerns about an extended recession and suggests another good cycle. He highlights that investors should pay more attention to the long-term picture than to short-term tails, since their analysis, which is supported by a wealth of data and historical patterns, supports this outlook. Remember to like this video, subscribe to the channel, and enable notifications if you thought his viewpoint was helpful so you don't miss any updates. We'd love to know what you think about the future of cryptocurrency markets, so please share your ideas in the comments section. We appreciate your time and hope to see you in the next video.